Afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and we have a very special session for you this afternoon where we're going to cover a pretty unique situation where a client of ours lost over $600,000 on a single credit spread trade, specifically on a credit spread trade that theoretically had only a $20,000 limited risk profile. How did this client lose over $600,000 on this particular trade? And more importantly, how can you avoid it? That's what we're going to discuss during today's session. So my primary goal today is to make sure that you understand, number one, when credit spreads can potentially blow up, and more importantly, how can you avoid it? So we're going to discuss this across two different sections. Number one, we're going to help you understand the methods to avoid account blowups when trading credit spreads, what you can do to avoid this particular unique edge case scenario that, even though is very, very unlikely to happen, could theoretically happen to you. And number two, more importantly, we want to show you how you can find the best yielding opportunities when you are selling credit spreads to trade so that you are setting yourself up for the highest probability of success when you are selling credit spreads. And when you're able to combine the combination of both, that's when you're able to grow your account confidently and sustainably, like we do here every single Thursday afternoon on these options education sessions to help you learn how to grow your account. Now, I see many of you have already chimed in saying hello and where you're from. So if you're joining us for the first time, please join us in the chat window. Let us know who you are, where you're joining from. As you can see, we have a very vibrant community of traders joining, all working together to help each other grow your trading account and learn from each other. Now, if you're joining us for the first time, you might be asking, are these sessions recorded? And if you can get access to the slides? And the answer to those questions are both yes. You can sign up for a free trial at optionsplay.com/signup or pointing your phone to the QR code on your screen. And that's going to give you access to the recording, the slides, and the tools that I'll be showing you during today's session. It's a free 30-day trial, takes 10 seconds to get signed up. And like I said, just point your phone to that QR code or go to optionsplay.com/signup to get access to everything that I'm showing you during today's session. So sorry, that's the QR code on your screen. If you need to point your phone to that QR code, you can sign up for that free trial. And I will also leave this up at the end of the session here as well if you want to sign up towards the end. So if we look at kind of the scenario, which had a trader, a very unique scenario, a scenario that may not happen ever again, but theoretically could happen to someone. And it's not very common, but we do see some occasionally big stocks that report earnings after the close on Friday. Those are the types of opportunities that can create this very specific setup that caused this one client to lose over $600,000 on one credit spread that theoretically only had a $20,000 limited risk profile. So the trade structure was on a stock, Biogen, BIIB. It's a biotech stock. So obviously biotech stocks in itself, in nature, is a little bit more speculative. And generally speaking, biotech stocks have the propensity to make big moves up or down on news of whether or not a drug has been approved by the FDA or a drug that has failed to be approved by FDA. And what happened in this particular case in November of 2020 was a bit of a combination of both things and a very unfortunately timed trade that caused this particular client to lose a substantial amount of capital beyond what was the theoretical limited risk profile of a credit spread. So before we kind of jump into the idea, before we jump into the trade itself, credit spreads or vertical spreads in general are marketed as a strategy with limited risk. And theoretically, there is a limited risk to these types of strategies. But if you hold them through expiration, there are some chances, very remote, but there are some chances where you could end up risking more money than that limited risk structure. So this is what I want to walk you through and help you understand how this happens, and again, how you can avoid it. So on this particular case, in November 2020, the FDA advisory committee initially expressed support for Biogen's Alzheimer's drug. This happened on Wednesday, November 4th. Now, if you look at your chart here, that's this big, big candle here to the upside. The stock basically jumped from about $255 or so to around $355 on that news that the FDA was showing some support of this particular stock. And on that particular day, when the stock jumped $100, this client sold 100 contracts of the 292.5 put for $3 and bought 100 contracts of the 290 put for $2.50. These premiums that I'm quoting here right now are rough premiums. They're not the exact premiums this client particular got executed at, but it doesn't really matter as to the exact premiums they got executed at. It's really more about the structure itself, okay? So this is obviously a sizable trade from the perspective it was 100 contracts, but because it was only a $2.50 wide credit spread, in this particular case, the client was only collecting 50 cents per contract. So $50 per contract times 100 contracts brought in this client a net credit of $5,000. Now, because this is a $2.50 wide credit spread, and because this client brought in 50 cents, that means $2, the rest of the $2.50 was the total risk on this trade. So the maximum reward on this trade was $5,000 versus the total risk, the maximum risk on this trade was $20,000. Even though it was a sizable trade of 100 contracts, the total risk was $20,000. And this client sold this credit spread on the news that this particular stock, that the FDA committee was expressing some support for this particular stock, and the stock jumped $100. And this client sold this bullish credit spread, hoping that the stock would effectively close above 292.5, which I'll bring up to you on the chart here, which is about right here. So at the time when the stock rocketed higher, the client sold the 292.5, 290 put credit spread, hoping that the stock will basically stay up above that level. On the very next day, that was on a Wednesday when the news came out. On Thursday, the stock pulled back a little bit. However, at that time, the stock got halted because of the particular news that the FDA approval was coming. However, unfortunately, what happened is the stock got halted for trading on Thursday. And on this particular day, this particular credit spread expired that following Friday. So even though the stock got halted, what happened was the FDA board ultimately voted against the approval of the drug after the close on Friday. So effectively, what happened was, even though the stock got halted, by the expiration date on Friday afternoon at 4 p.m., even though you couldn't trade the stock at the time was the last price of the stock was around $330. So in this particular case, this particular client thought, well, I sold the 290 for 2.5 put. I bought the 290 put. The stock's currently trading at 330. Even though the stock got halted, I'm good because the stock is well outside of the credit spread of the short strike of the credit spread. So I'm just going to leave it. I'm going to hold it through expiration, and I'm going to make my $5,000. Unfortunately, what happened was that the news came out on Friday afternoon after the close that the FDA voted against this particular drug, and sent the stock significantly lower. But because the stock halted, this client didn't think about how far the stock could open up lower on Monday morning, and also did not, and also because once you're short a option going into expiration, once expiration is passed, there's nothing you can do as a short holder of that option. You are at the mercy of anyone who chooses to exercise that call or put after hours, even if it doesn't theoretically make economic sense for them to do it. But in this particular case, what happened is the buyer of a 292.5 put realized that the FDA voted against this particular drug, believed that the stock was going to open significantly lower on Monday, and chose to exercise the put, even though the put at the time was about $40 out of the money. So in this particular case, what happens is on the following Monday, the stock ended opening up at $230. So the stock closed at 330, opened at 230. And because this client held this short credit spread through earnings, there was nothing they could do other than accept assignment of what is effectively 10,000 shares of Biogen at the 292.5 strike price of the put option that they sold. So what happens is this limited risk strategy that theoretically had a limited risk of $200 per contract, and for 100 contracts is $20,000. The short put was assigned to this trader for 10,000 shares because 100 contracts represents 10,000 shares at the $292.5 level. And when the stock opened up at $230 on Monday, this trader opened up their account on Monday to a $625,000 unrealized loss and a margin call on their account as a result of this particular trade. So what can we learn from this? It's that when you sell a credit spread and you hold it through expiration, expecting that, hey, the markets are well outside of my short strike, I'm going to hold it through expiration so I can eke out every single last cent out of my credit spread. There is the small chance that something happens between 4 o'clock and roughly 5:30, which is the last, you have about an hour and a half to exercise your calls and puts to the OCC if you're a buyer of a call or put. There could theoretically be some news in that hour and a half that leads you to believe as a buyer that it is worth exercising a call or a put, even though it technically expired out of the money, because it doesn't matter that a call or put is in the money or out of the money. Someone could choose to exercise a call or put regardless of whether it's in the money or out of the money. It just happens to be that if a call or a put is out of the money, 99.99% of the chance, 99.99% of the time, it doesn't make sense for that buyer to be exercising that call or a put. But in this particular case, because some news had came out after hours, and there was still time for this trader to execute or exercise their put option in this particular case, they chose to do it, even though the put option theoretically was out of the money at expiration. So as an option seller, you are effectively at a disadvantage because there is effectively an hour and a half after the close on Friday where there's nothing you can do, but theoretically you're exposed to any potential movements in that particular stock, where the buyer of the option has a choice in that hour and a half. If something happens, they could choose to exercise that call or a put. And in that unlikely event, if that were to happen, and it causes you to effectively be long or short the stock on Monday morning, and the stock has moved materially against you by Monday morning, you could have a loss that exceeds the limited loss potential of the credit spread, because the exposure that you have is actually post the expiration. The theoretical limited risk of the strategy is only through expiration. But once you get past expiration, all bets are off. So this is really what you need to be aware of before you sell a credit spread and choose to hold the credit spread through expiration. Does that make sense to everyone? Please type 1 into the chat window if that makes sense to you. And yes, here's the thing. Someone made a really good point. This person was long the 290 puts. Couldn't they have exercised this 290 put to offset the long 100 shares they would have to purchase at the 292 and a half put option? And the short answer to your question is yes. This person could have exercised their 290 puts and actually taken advantage of that. However, this client did not do that. Did not think that they needed to do that, and simply walked away because they thought that this credit spread expired out of the money and they were going to capture the $5,000 on this particular trade. Because if news comes out after hours and you weren't sitting around your screens to find out about it, or you found out about it on Saturday morning instead of Friday at 4:30 p.m., that's kind of the tough luck that this client had to live with because they didn't choose to exercise their 290 put. But if you did find yourself in a position where you sold the credit spread, and then something, I'm just trying to remember a couple of times in the last few years. There was a time, and I think in 2020 or 2022, where Tesla reported earnings after the close on Friday. Very unusual for a big stock like Tesla to report after the close on Friday, but it did happen once, and it did end up blowing up quite a few accounts. People who were short call options, that where the call option expired out of the money, but by Monday morning they found themselves short the stock, and the stock was significantly higher. Nike also reported after the close on Friday a couple of years ago that also caused some issues. So it's not common for most major stocks to report earnings after the close on Friday, but we have seen a few events of these over the years. For whatever reasons, stocks just chose to choose that Friday expiration. It's not a very popular time to announce earnings, but ultimately every single Friday after the close, there are a few companies that announce after the close, and this is a scenario that could cause this to happen. But the point that someone made is that you could have exercised the long puts to offset this risk, and that would have limited your loss to the $5,000 if this client did choose to exercise those long puts. But like I said, if you didn't catch the news in time and put in your exercise notice within the hour and a half that you have to place your exercise notice, then you are exposed past the earnings expiration. Very, very good observation. So in this particular case, the client didn't actually lose $625,000 because ultimately the brokerage firm is ultimately responsible for allowing this client to effectively hold this position through expiration. And the brokerage firm did have to end up eating some of this loss. And granted, the brokerage firm recovered some of it because the stock did recover to some degree after the earnings, right? Just it opened at 230, and within a couple of days, it traded back up to 255. That limited the losses in itself. And then the brokerage firm ultimately ended up having to eat some of that loss from the client. So if the client, let's say, had $50,000 in their account, it would have wiped out $50,000 of their equity. So even though they might not have lost the 625, and if this client did have let's say $3 million in their account, they would have lost $625,000 if they closed that position on Monday morning. So that is the scenario where you could put yourself in a scenario where this could happen. So more importantly, the question is, how do you avoid it? So first and foremost, to avoid this particular scenario, it's actually quite easy. It's not hard at all to put yourself in a scenario to make sure that this never happens to you. And it all comes down to just basic credit spread management. So we've been showing you this particular slide at every single juncture if you've learned how to trade a credit spread here with us at OptionsPlay. If you're doing this for the first time, it's important to understand that when you're selling credit spreads, there are three possible triggers to exit a credit spread. There is a stop loss level, there is a take profit level, and there is a time-based level. And all three rules are designed to effectively avoid this exact scenario from happening. So the first is basically avoiding even getting to a point where you have a full loss on this particular trade. And that is using a stop loss at around 100% of the maximum gain on this particular trade. And I'll walk you through an example of what that means. On the flip side, you also want to have a take profit order at about 50% of the maximum gain of the credit spread. And for those of you that are, if you trade with Schwab and you have access to a Thinkorswim trading account, Brian, our senior option strategist, recently just um, our strategist, Brian Overby, just recently hosted a session on Thinkorswim on how to place a bracket order so that you can place both a stop loss order and a take profit order at the same time. It's the only options brokerage firm that I'm aware of. I think Interactive Brokers allows you to do it as well, but Thinkorswim and Interactive Brokers, I believe, are the only two major brokerage firms that allow you to place a stop loss order and a take profit order on a complex strategy like a credit spread at the same time. Most brokerage firms limit you to do one or the other, which is limiting in my opinion. Tasty Trade unfortunately does not do that. It is one of the things that I kind of have an issue with Tasty Trade, even Thinkorswim, obviously built by Tom Sosnoff. Tasty Trade, I don't believe, offers the OCO bracket order on complex option strategies. But if they do, that's great. If they do, that's fantastic. But I don't believe they offer the OCO bracket on complex orders. So this is something that you definitely should ask your brokerage firm as to whether or not they support that. But any brokerage firm that does support that, number one, what this prevents many times is from holding a credit spread through expiration, because an OCO bracket order effectively will take profit or stop loss your trade before it reaches either maximum profit or maximum loss, which will only happen as you approach expiration. But even if the stock just basically stays where it is and you don't quite reach that stop loss or take profit order, that's where the third component of our risk management strategy for credit spreads comes into play, which is exit your trade at 21 days to expiration. And this is to avoid at all any possible early assignment scenario where you could find yourself at a loss that's greater than the theoretical limit of a credit spread. Now, here's the thing: is that early assignment doesn't carry the same risk as what I showed you, right? Where you get effectively assigned after the expiration date. If you get early assigned, then your long leg of the credit spread will always offset any particular losses that you have on the long short equity leg that you have once you are early assigned. So as long as if you do get early assigned, right, your risk will remain the same. Right, unless you hold it through expiration and you let the long option expire worthless or expire, and then you continue to hold the equity position past the expiration date. In that particular scenario, yes, you could lose more money than the theoretical loss of a credit spread. But if you get assigned early, early assignment doesn't change the total risk of the particular trade. It obviously changes the structure of the trade, and you need to have the margin to hold on to that long or short equity leg. But the risk doesn't change if you do get assigned early. But we don't want to get assigned early. We want to avoid that as well, which is why we want to exit all credit spreads at 21 days to expiration. Now, for some of you, if you are trading shorter dated expirations, if let's say you're trading a 14-day credit spread, you obviously can't exit a 14-day credit spread at 21 days. What you want to do is you want to have some form of a time-based exit strategy to exit before the actual expiration date of the credit spread. So let's say you do theoretically sell a 14-day credit spread, or even let's say you sell a 1-day credit spread. You always want to have some kind of time-based exit strategy where you are exiting the trade prior to the expiration date of the strategy. The only exception to this is if you're trading an index option, those that are cash settled. Cash settled index options do not have this exercise risk that I'm referring to. But in all stock or ETF options that have physical delivery, this risk exists. And what you need to do is make sure that no matter what your strategy is when you're selling credit spreads, that you have a time-based exit strategy attached to your credit spread to avoid this particular scenario. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. Okay, so just to help you understand, right? If let's say I'm looking at selling a credit spread, in this particular case, I'm selling the 100, 120 call credit spread, and let's say I collect $8 for that credit spread. Everything when we set our stop loss, when we think about an OCO bracket order, is going to be relative to the $8 that I've collected on this particular credit spread. So when I say we want to take profits at 50% of the maximum gain, what we want to do is basically set a take profit order at 50% of the $8, which is $4 at a $4 debit, right? So if you sold something for $8, it's now trading at $4. What that allows you to do is basically exit the trade once you've made 50% of the total potential of the trade. On the flip side, if you sold something for $8 and the trade starts going against you, that means the value of the credit spread is expanding. You sold something, you want it to go down, but if it's going against you, then it's going up. You want to set a stop loss at about $16, 100% of the total maximum gain potential of the credit spread. And this allows you to bracket the order on both sides so that if it goes in your favor, you take profit. If it goes against you, you cut your losses. But that third component, that 21 days to expiration, is important to have on your strategy to avoid any concerns of early assignment and avoid your concerns of holding this through expiration. So no, 21 days. The reason we use 21 days is because we typically sell credit spreads that are about 45 days out. And if you exit your trade at 21 days, or if it triggers a stop loss or take profit, I would say 99.99% of the time, you will not see an early assignment, and you will certainly never see expiration if you follow these rules. In that 0.001% of the time, you could see an early assignment. And if you get early assigned, what you want to do is you basically want to exit the equity leg and exit the long call or put leg. That makes it so that if you do exit both the equity and the call put leg, or the long call put before expiration, your maximum loss remains intact. It's only if you hold it through expiration, post expiration, and the long call or put expires, and you still continue to hold on to the equity position past that expiration date, that's when your exposure can be greater than the theoretical maximum risk of the credit spread. Okay, so let's talk a little bit about credit spreads. Let's kind of circle back to credit spreads now, because we've talked about what is the worst case scenario, how it can happen, and how to avoid it, right? And hopefully 99.99% of the time that won't happen to you. This was a very, very unusual edge case that was unlikely to happen again, but it's important to understand theoretically how it can happen so that you basically never put yourself in a position where it could happen to you. So let's now circle back a little bit to credit spreads. Now, I'm presuming most of you have some experience trading credit spreads, if not have lots of experience trading credit spreads. But for some of you here that if you're relatively new to credit spreads, I do want to give a bit of introduction to credit spreads and show you how you can find some of the best yielding opportunities from a credit spread perspective. So just a very quick overview. A credit spread is an income generating strategy for what we consider a mild directional view on a stock or ETF. What that means is that as long as the stock is starting to trend in one direction or another, that's the only criteria you generally need to potentially initiate a credit spread. There are a lot of other option strategies where you need to believe that the stock is going to make a big move in a short amount of time before you might want to utilize that strategy. So for example, if buying a call option or buying a put option, those are two strategies where you need to believe the stock is going to make a big move in a short amount of time before it makes sense for you to buy a call option or buy a put option. Not the same with the credit spread. You find far more scenarios to potentially sell a credit spread than you do where you think the stock's going to make a big move and it's justified to buy a call or a put. So it's a forgiving strategy with a higher probability of success, which I tend to find helps build confidence for a lot of traders that are new to trading options, and it has limited risk and limited reward. Now, we did talk about, when that limited risk factor can blow up, but hopefully, what we covered in the first section is really clear rules as to how to avoid that and to make sure that these strategies have limited risk and limited reward. And the benefit of that is that you know exactly what you could potentially make or lose before you get into a trade, which means that if you ever sell a credit spread, and you afterwards you say, oh crap, I lost too much money on that credit spread, the only person you can blame is yourself, because you know exactly how much money you could potentially make or lose before you get into a trade. So if after you place the trade and you say, hey, I lost too much money, the only problem that you have is that you traded too many contracts of that particular strategy. So you can only blame yourself. You cannot blame anyone else. So that is a tough thing to swallow, but that is the truth. So if you ever, and please raise your hand or type yes into the chat window if you've ever sold a credit spread and afterwards said, crap, I lost too much money on that credit spread. Unfortunately, the only person you can blame on that is yourself, because the only person that can control how many contracts you sell is yourself. So you know exactly how much you can risk. You have control over that. You need to make sure that you set that up before you get into a trade. Okay. So let's talk a little bit about the optimal credit spread, because when you generally sell credit spreads, the goal with a credit spread, the minimum of a credit spread is that you want to collect 1/3 of the vertical width. So in an example of a credit spread where you sold the $97 put and you bought the $88 put, that is a distance between the two strikes of $9. So whenever you trade any vertical spread, the distance between the two strikes is the total amount that you're playing with. What that means is that if you collect, let's say 1/3 of that vertical width, so $3 out of the $9 wide credit spread, the rest of the $9, which is $6 in this particular case, that's going to be your total risk. So in this particular case, if you're going to collect $3 on a $9 wide credit spread, you effectively have a 2-to-1 risk reward ratio. For every $1 you can potentially make, you're risking $2 on the back of that. And that simply requires you to be right 67% of the time just to break even. So if you have credit spreads where you make $1 at a time when you're right, and maybe you have 2 winning trades of $1, and you have 1 losing trade where you lose $2, you have 1 winning trade where you win $1, 1 winning trade where you win $1, and you lose on a trade and you lose $2. What do you get at the very end of all of that? You get a big fat zero, big fat goose egg. And a lot of traders will say, what's the point of selling a credit spread where, your expected value is zero? Why would I want to shoot for that? And my answer to you is that most traders don't even get to break even. A lot of traders are losing money on their trading. So what our goal here with credit spreads at the minimum is to get you to break even. However, what you're going to find is that there are lots of opportunities when you're selling credit spreads where you don't collect just $3 or you don't collect just 33% of the width. You can actually collect a little bit more. And that is the edge that we want to seek when we're selling credit spreads. So if we're selling a $97 strike put and we're buying an $88 put, what we want to do is we want to find credit spreads where this $9 wide credit spread, instead of collecting $3, is collecting $4. And what that means is your total risk here is about $5 instead of $6. That brings your risk to reward ratio to about 1.5 to 1, actually slightly better than 1.5 to 1 in this particular case. And that is going to require only 60% of your winners to break even. So if you have 2 winning trades where you win $1, 1 winning trade where you lose $1.50, 2 winning trades where you win $1, 1 losing trade where you lose $1.50, if you repeat that over and over again, what do? You start gaining an edge. You start having positive expected value. And that's how you start growing your account and start building account equity in your account on a more consistent basis. But that's not the only place that you can gain an edge. There's an edge that you can gain on the options trading pricing, but there's also an edge that you can gain from a direction perspective. So like I said before, you can sell credit spreads whenever you have just a general trend, right? So if you look at this particular stock, this is a stock that is generally in an uptrend, right? And then any point within this roughly 1 year time frame, when the stock went from $58 to $84, if you sold a credit spread at any point of the year, meaning you have no concept of timing, you just saw that it was trending higher, and you just sold the credit spread every single time you saw that stock was trending higher, you would have made money almost throughout the entire year. However, that doesn't mean that that is always the best strategy. Meaning, even if, let's say, you sold the credit spread right here, right? Let's say you sold the credit spread on this one day, a bullish credit spread in this particular case. You would have had to sit through a little bit of chop, right? Meaning small loss, flat, small loss, flat, a little bit of a bigger loss, but eventually it kind of turned back in your favor and you would have made a profit on this particular trade. It's a very simple and very forgiving strategy. And many times, even if the stock basically just trades sideways, you can still make nearly the maximum profit on this particular trade. So however, if let's say you timed your trades where instead of entering the trade on that particular candle, let's say you entered the trade on this particular candle, what happens is that you basically end up being profitable almost immediately, and you exit the trade within just 5 to 7 business trading days, as opposed to in the previous example, you would have made money in the previous example, but you would have had to sit through this trade for probably 3-4 weeks before you were able to take profit on this particular trade. So there is a distinct difference in terms of timing that can clearly give you an edge versus just looking for an edge from an options trading perspective. Does that make sense, everyone? Please type 3 into the chat window. What you're looking for are credit spreads that collect more than 33% of the width, and then you want to time your trade specifically so that if you are in an uptrend, what you wait for is a bit of a pullback, so that if you do wait for those pullbacks, you tend to have a much shorter time frame trade. So if you wait for a bit of a pullback, you can be profitable much quicker and be profitable in not only much quicker, but also not have to sit through days and days of chop where you could see some unrealized losses before you start to see some gains on that particular trade. Same thing on the bearish side, right? If you're looking for a bearish trade, what you want to do is you want to wait for rallies in a bearish trend and then enter. If you wait for rallies and enter, you can be profitable very, very quickly, as opposed to having to sit through chop, right? If you had sold a bearish credit spread here, right? Would you have made money on this trade? Theoretically, you would have eventually, but you would have had to sit through quite a bit of unrealized losses. And this would have been very uncomfortable when you sold the credit spread when it was trading at 74 and the stock rallied all the way up to 78 before it eventually came back down below 74 for you to be profitable. And sometimes theoretically, you could have even gotten stopped out here and then only to see the stock move in the direction that you expected to. And I know many of you have found yourself in that particular scenario where you got the directional view correct, but your timing was just off. You got stopped out, and then the trade went in your favor. And what you have to do is you have to get better at timing. And this is something that I actually, spend quite a bit of time on, is showing people how to time their trades better. But I think based on what I'm showing you here today, really begs the question: how can you make sure that you identify, scenarios where, one, you have an edge from an options trading perspective, and then you have an edge from a timing perspective. And that's really where the OptionsPlay credit spread trade ideas section is designed to automate everything that I just showed you here today. Because our credit spreads on our platform automatically only select credit spreads that generate more than 33% of the vertical width. It's actually ranked based on which ones have the most amount of yield, meaning where do you get the most edge is always at the very top of the list from a credit spread perspective. So most of the stocks that we're going to look at, you're going to see 37, 38, 40, 42% edge on a credit spread. On top of that, our credit spread is only looking at very liquid underlying symbols, so that you know that if you found an opportunity, you can execute the trade at the price that we're quoting you, basically near the midpoint, if not at the midpoint of a credit spread. And then also, third of all, it also aligns with our technical directional view from a timing perspective. So I just want to show that to you here on our platform. So when you go to the OptionsPlay platform, under the ideas section, there's a drop-down menu, and you can choose from that drop-down menu whether you want to look at technical ideas, cover call ideas, short put ideas, or credit spread ideas. And as you can see today, we have 124 credit spread ideas. I just want to show you kind of what that looks like. And I'm going to look at SPY. SPY currently, actually, as you can see, collects 47% of the vertical width. Very, very uncommon to see that for a credit spread to collect nearly 50% of the vertical width. But we saw a bit of that here during the initial sell-off, at the beginning of April, and we're seeing it again. And I think this is something that I think is worth looking at today. This is updated every single hour, this credit spread report. So so you're basically getting new opportunities, throughout the day. But basically, as you can see, we're clearly in a bit of a downtrend here in terms of the S&P 500. And what we want to do is we want to wait for these uptrends to enter that bearish trade. And that's sort of what we're getting right now, is a bit of an uptrend. So I'm not saying that the S&P 500 is moving lower, but from a risk to reward and from a timing perspective, it is favorable for bearish to adding bearish exposure at these specific levels. So if you do believe that there's some downside going forward from in the S&P 500, well, here is an opportunity that you can sell the June 13th 562 590 call vertical, and you're going to collect $12.12, which is $1,200. And as you can see, the risk to reward ratio on this particular trade is pretty close to 50-50 or 1-to-1, which is something you don't ever see on stuff like, ETFs like SPY, QQQ. Usually you have about a 3-to-1 risk to reward ratio. Here you have a very unusual 1-to-1 risk to reward ratio. So, our tool is designed to help you identify where you find the highest risk to reward ratio. So VOO, which is obviously Vanguard's version of SPY. So and that's why the chart looks almost identical to SPY. But Vanguard's ETF is actually collecting, in this particular case, a little bit higher, 49% of the vertical width. Now, this is based on the premiums from, when the report run. But when you click on it, we're actually pulling the latest pricing here on your screens. And right now, this is going to collect a little over $1,000 in potential reward versus the $1,200 in total risk on this particular trade. So you're still very close to 1-to-1. So whenever this column here on the left updates once an hour, but if you click on any of these specific ideas, it's going to pull the most recent pricing to give you the most updated pricing for your particular trade. So if you sold this HPE 18.5 call vertical, you're going to collect 60 cents versus 90 cents, so about a 1.5-to-1 risk to reward ratio on HPE. And you can basically go down the list, and as you go down the list, basically the premium versus width gets lower and lower. So basically what you want to do is you want to start at the top of the list and work your way down. And as you can see, what we're doing is we're basically doing all the work for you on the options trading side and from the timing perspective. So any of these ideas that you're looking at, let me look at some bullish ideas just to kind of show you what those look like. Let's look at Dollar General. This is collecting 39% of the vertical width. You can also do it on GLD. As you can see, what you're looking for are stocks that are in an uptrend. That's what we've got here for Dollar General. And what you look for are these kind of pullbacks in this uptrend. That's kind of what we've gotten so far, is a little bit of a small pullback. And that is your opportunity to get in the trade and potentially be profitable in a very short amount of time. And that's exactly what we have here on Dollar General. So our tool basically does all of the work for you in automating, finding liquid option underlying symbols, sorting, credit spreads based on where you get the most premium, meaning the best risk to reward, and it also filters out where the timing is not optimal. It only puts an idea on your screen when the timing is optimal for that entry, so that you can basically get all the things that we just discussed here: the edge from an options trading perspective, and the timing where you are basically waiting for these setups for a bullish opportunity and waiting for these rallies to enter that bearish opportunity. So regardless of whether your views on the markets are bullish or bearish, you can always find the best yielding opportunities selling credit spreads using the OptionsPlay platform. And it's all here on your platform under the idea generation section. Once you click on credit spreads, you can even sort and filter based on bullish and bearish, or you can just select all of them and see all the opportunities. but it is pretty unique opportunity that we're currently seeing in SPY. You're seeing in DIA. You'll probably see it in some of the IWM. So basically, all of the major indices are flashing the same signal, and it's because we've had a nice rally here in a lot of these major indices, and these indices are starting to show some slowing momentum. That means there's a higher probability that it's going to start rolling over and start seeing a little bit of a move here to the downside, and and that is a potential opportunity to add some bearish exposure. Again, I'm not saying that the markets are going to move lower from here, but we certainly have all of the components that you would typically look at where the probability and the risk reward looks most favorable right now for adding some bearish exposure on the major indices. So with that, that covers what I want to share with you here today. I hope that this is helpful in giving you a better understanding of credit spreads, how to make sure that you avoid any possible scenario where you could get yourself into a trouble like this one client did. It's very unlikely, but it could potentially happen to you. So it's really important that you understand how it can happen, how you can avoid it, and then every single day when you're selling credit spreads, how you can find the best possible opportunities selling credit spreads. So while you point your phone, while you bring up the Q&A window, which is at the bottom of your screen, if you do want to sign up for a free trial to OptionsPlay to have access to all the tools that I just showed you today, including the recording and the slides from today's session, sign up using the QR code on your screen at optionsplay.com/signup, or point your phone to the QR code that is on your screen. Okay, so I'll leave that up here for a minute while I pull up the Q&A window. You can pull up the Q&A window, type your questions there, and I will answer your questions out of the Q&A window. This client, I have no idea where this client chose to trade this. I would have never traded a $2.50 wide credit spread that was, the stock was at 330. This was a credit spread that was $40 out of the money, selling a $2.50 wide credit spread. I would have never traded something like that. So I don't know where this client got this idea, and a lot of traders do this, right? It was a very high probability setup when the trader entered this trade. Like I said, I don't know what the premiums that they got executed at were, but they probably collected pennies for the potential risks. And at the time, when you traded 100 contracts and you felt that this option was $40 out of the money, there's probably had a 90% chance of being successful on the trade. A lot of people do this, but it's just, and a lot of times it's these really far out of the money credit spreads where people get into trouble because they just think, there's no way this thing's going to expire in the money, so at expiration, they just hold it through expiration, and if you're only collecting 10 cents on a credit spread, you want to eke out every single penny. So the only way to do that is to hold it through expiration. And that's really where the risk happens. Someone just said Netflix reported on Thursday when the market was closed for Good Friday this month. And yes, yeah, that's a really good point. Netflix was, I'm sure some people got caught on that Netflix trade as well, where, you get an option that looked like it was expiring out of the money. Earnings came out better than expected. The stock popped and you thought your call option expired worthless. Next thing you know, on Monday morning, you're short 100 shares of that stock for every contract you sold. Is a brokerage firm not responsible for letting you know that the options were exercised? Yes, but there's nothing you can do. If you hold an option through a short option through expiration, there's nothing you can do at that point, right? The only thing you can do is if you close out that option prior to expiration, that's the only thing you can do. Otherwise, you just end up being, long or short the stock on Monday morning. Now, here's the thing. Options assignments are assigned theoretically randomly. OCC goes to a brokerage firm and says, there are 5,000 contracts that are that have been exercised. A brokerage firm XYZ, you get 100 contracts. Brokerage firm XYZ, you get 300 contracts. Brokerage firm blah blah blah, you get 500 contracts. It's theoretically distributed randomly to the brokerage firms, and then within brokerage firms, it's theoretically distributed randomly to individual accounts. This person just happens to have been on the wrong side of that particular exercise notice. Um, Stop loss at 16 when net credit received is 8, but since we're taking profit at 4, can we use 8 as a stop loss? You can't use 8 as a stop loss if the trade is traded at 8, because that means as soon as you enter the trade, you would have been stopped out. So you have to have a stop loss that's above the price that you enter the trade at. A cover call, same thing. You have the same risk with cover call. Well, I guess, sorry, you don't have the same risk with cover calls because you own 100 shares of stock, right? So that if the short call gets assigned and you end up being short 100 shares of stock, the whole point of the long 100 shares that you own is to offset that short position that you have. So you don't have the same risk when you have a cover call. It's only for credit spreads or iron condors for that matter. Do you have to do the sell put, or will it automatically, when you get assigned the put you sold? I'm not sure I understand your question, Mike. If you don't mind clarifying that. If your question is, I think I understand the question, and correct me if I'm not understanding it correctly. I think the question is basically, if let's say the short option gets assigned, do you have to manually exercise the long put to offset it? And the answer is yes. You don't automatically get the long put exercise unless the stock, unless it was in the money for both of these, right? If it was in the money for both of these, then you would have been assigned on the short strike, and your brokerage firm would have exercised you typically get auto exercise on in the money contracts. So those two would have offset each other on Monday morning. But if they were both out of the money at expiration, theoretically, and something happened after hours, that's really where you can get caught out. Brokers that do not allow OCO orders on complex trades, could you just set an OCO on the short leg? I guess you could. That's an interesting suggestion. Is that if your brokerage firm only allows you to do an OCO on a single leg, could you do it on the single leg and leave yourself with the long leg? Yeah, I guess that's possible. I'm just trying to think how you would price your single leg. I think the tough part is really figuring out what premiums to put those OCO orders at, but theoretically you could. Um, Someone saying in volatile stocks, sometimes closing at 21 days before expiration tends to leave a lot of money on the table. Is it still better to get out in such a scenario? You don't have to just get out. You can basically roll it to a new 45-day credit spread, right? So you don't have to necessarily leave money on the table. You just want to roll your credit spread out a new 45-day credit spread. You can continue to gain, you can continue to have your exposure and continue to try to gain more from that particular trade, especially if you still believe in the directional view of that trade. So I'm not saying you have to get out of the trade and full stop and be out of that stock. You just have to roll it back out to a new 45-day credit spread, because rolling it out basically avoids this whole assignment risk or early assignment risk as you approach expiration. It's a great question, and I think that was something that I sort of failed to talk about at the time. But if you reach 21 days to expiration and you think that this stock still has room to grow, just roll it out to a new 45-day credit spread. During pullbacks, we collect less premium too. You don't. You collect, the whole point of our credit spread report is to find you where the timing is correct and you're collecting, significantly higher than 33% of the premium. You don't have to give up premium just because you're trying to wait for the best timing. A lot of times, the best timing actually gives you the best credit as well on a credit spread. Is it advantageous to use RSI as an entry or exit point using 70 or 30 as oversold? Yes. So when I talk about timing or optimal timing, any type of these momentum indicators like RSI is a tool that you can use to optimize timing, right? So for example, if let's say you pull up, this is not particularly RSI, but pretend it is RSI. When I'm telling you that the timing here is great for selling options, it's because the RSI, or in this particular case, the CCI is overbought, right? So yes, technical indicators are what you would want to use to optimize the timing aspect of the trade. Is there a video on timing the trades better? Yes, I recently just hosted a video a couple of weeks ago specifically on timing and the tools that we have here at OptionsPlay to help you better time your trades. We have a watch list built recently on overvalued and undervalued stocks. And I think the biggest fallacy, I think, for a lot of traders with fundamental analysis is the fact that you can run a screener and you can see that there are 66 stocks that we deem as undervalued, but it does not mean that now's the best time to buy those undervalued stocks. Just because you deem something as undervalued does not mean that now is the best time to buy the stocks. That's why we built our ideal screener on top of our undervalued stock watch list so that we can find the best opportunities to actually buy these stocks. So these 19 stocks out of all of our undervalued stocks have generated some kind of trade signal today. And that's where when you can look at these particular stocks and see where there are opportunities to buy. These are kind of where the timing potentially are best to be buying those particular stocks. So this happens to be a bearish, signal that was generated on our undervalued list. So you sometimes have to go through this list and see which ones have generated a buy signal. And we are doing more work so that, you don't have to do so many clicks. You can just find, where the fundamentals and technicals all align with each other. There's some new work that we're doing along those lines to make this even easier for you. But yes, I recently have hosted a webinar specifically on market timing. But the credit spread tool has already built the timing into it so that it's all automated as part of the credit spread trade ideas section. Please let me know on the credit spread. When I close the credit spread, do I have to close both sides the same day? Yes, you want to close both legs at the same time. You never want to break up the execution of the two legs of a credit spread. How do you know when the pullback has stopped? You don't know when the pullback has stopped. You don't, right? But you're basically using statistics to say, at this point. So, for example, let's go back to SPY. SPY, the momentum indicator, has rallied enough to get to a point where you're basically saying the probability of a pullback here is high enough for me to now enter this trade, right? Meaning a couple of days ago, theoretically, it was a rally, but it had not rallied enough where the probability was worth entering. And it really was once it reaches, and that's why there's a red arrow here. The red arrow is generated once the probability is reached a high enough level where the probability is high enough to justify entering a bearish trade. So we basically use technical analysis to measure the probability, and it has to exceed a certain threshold before it triggers an actual a sell signal. But ultimately, you don't know for a fact that it's going to stop there. It's just that at that point, it's high enough to justify entering the trade. The idea generation is only based on timing, right? So when you look at technical ideas, the only thing we look at there is timing. We don't look at fundamentals. You don't look at options. We're just looking at timing. So it's different ways to approach sort of the same problem, right? Do you look at the options first? Do you look at timing second? Or do you look at timing first and you look at options second? So, and So if you look at things like the cover call short puts, that's looking at options first, and then you're trying to look at timing afterwards, right? The technical ideas is looking at timing first, and then you're looking at the options afterwards. The credit spread happens to be the one report where we're kind of looking at both at the same time and only giving you the ideas where both have already been satisfied in order for you to see something that's part of the credit spread report. Can you go over how to switch from bearish ideas to bullish credit spreads? Yes. So when you're under the credit spreads, there is a button here, a settings button. And when you click on that settings button, you'll see at the top there's two selections: bullish credit spread, bullish put spread, and bearish call spread. So depending on which one you select, you can basically see bullish credit spreads, or you can see just bearish credit spreads, or you can see both at the same time. Hopefully that answered your question, William. Um, is it possible to leg out of a short leg of a spread using a stop movement order and holding the long leg until expiration? You could. I don't recommend doing it, but you could. You could choose to exit a credit spread. Strategy is commonly used in SPX option to avoid paying commissions on closing the long leg. Traders avoid of. Yeah, so if you're talking about trading 0 days to expiration strategies where you're kind of really far out of the money, and the cost to exit those trades are relatively higher. Um, there was a notable case where a trader lost. Mm, I have to look into this specific example that you're talking about here. I'm generally not a huge fan of selling credit spreads. I'm sorry, breaking up a credit spread. And in SPX, when something is cash settled, you don't have the same issue when something is cash settled, meaning you could just hold it through expiration, and you don't have assignment risk because it's cash settled. So I don't know that this is as relevant for SPX as it is for, let's say, SPY. Great question here. Someone's asking, when we sell credit spreads where the short leg has a high delta, isn't that very risky? It's actually the exact opposite, right? So let me just walk you through that thought process here. So we sell this credit spread that has a near 1-to-1 risk to reward ratio, right? We're selling an at the money credit spread. This is the exact opposite of risky. We're risking for every $1 we can potentially make, we're risking about $1.10 or so, $1.20. If you were to sell a low delta credit spread, right, which is something like this, why can't I go any higher? It's because there are no strikes above 595. Which is odd for that, but let's move to a different expiration, right? Just to kind of work through this. So let's say we sold the 550 quote. Hold on, let's start at the 558 just to kind of recenter this again. Let's go back to our original strikes, right? So this is the strike that we would have sold. As you can see, you have a near 1-to-1 risk to reward ratio. Think about risk from a risk to reward ratio perspective. How much can I potentially make for every dollar I can lose, right? So when you sell an at the money credit spread, my risk to reward ratio is nearly 1-to-1. I think of that as low risk, right? Because if I make $1, I can only risk maybe $1.10. Now, if you choose your low delta credit spread, right, you have a higher probability of success, but for every $1 I can potentially make, in the off chance that it does go against me, I'm risking, orders of magnitude more than what I can potentially make. I think of that as high risk. It's a different perspective of how you think about it. But if you really think about risk to reward, when you sell an out of the money credit spread, you're taking on far more risk. You have a higher probability of success, but you're taking on far more risk. So if you're trying to reduce risk, the high delta at the money credit spreads are actually where you're going to have the least amount of risk. You could also get into trouble with debit spreads on the short leg. You can get in trouble with the debit spread if you actually end up in between the two strikes. Basically, the long leg gets automatically exercised. The short leg is assigned is expires worthless. And let's say it's a call debit spread. And the stock ends up in between the two strikes at expiration. So the short leg expires worthless. The long leg automatically gets exercised. And some news comes out over the weekend or Monday morning, and the stock plummets on Monday morning. So you got exercise. You own 100 shares of the stock, and the stock plummets on Monday. That's a risk, also with debit spreads if you hold it through expiration. Um, it's a different scenario, but there are scenarios where, again, this is why we always say don't hold options through expiration. Even if you think it's going to be out of the money and you're not going to have a problem, something could always happen after hours that causes an issue. With SPX, is the same principle applied to the width of the spread, or is it per contract? I'm not sure I understand that question. But it's the same. It doesn't matter whether you're trading SPY or SPX. It's the same concept. Okay, that is all the time that I have for today for questions. I hope that this is helpful in giving you a better understanding of credit spreads, and just to kind of the very small edge cases of what could happen and why it's so important to manage risk and manage your credit spreads. It's very unlikely that this could happen to you, but in the off chance that it does, we want to make sure that you don't put yourself in that scenario. And more importantly, we want to make sure that you always find the best possible credit spreads to get into to begin with, with using tools like we have here at OptionsPlay with our credit spread finder. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.